Mike Zuzolo is back to talk about some blackouts in China forcing shutdowns on China's crushing facilities, and yet the Federal Reserve anticipating its tapering decision in the United States. That is all on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. If you are new here, please make sure you subscribe. So, Mike, how are you today? I want you to comment that I heard about at least 10 facilities in China that will be forced to shut down due to energy blackouts.
Yeah, 10 to 20 facilities is what I'm hearing as well, Luis. What I've been able to find out over the course of the last couple of days since this news broke back on last Friday is that China's Rust Belt, which is kind of their northeastern provinces, are the ones that are being hit the hardest with these blackouts. And what we have provided for the viewer today is a crush margin chart, for one of the major provinces in China for how much profitability that they are currently seeing right now versus just a couple 3 months ago, which was deeply negative. And so they're back up into a very profitable crush margin right now. The price of soybeans has declined. So I think you first go, when it comes to China, you go to why is it happening? Well, you rule out things that it probably is not, and then try and narrow down what it probably is. And so it's not the crush margins that are causing this. It's not the price of beans being too high that's causing this. What it could be, though, I think, is just the sheer price of electricity to generate. We are hearing that right now the price of coal to generate power right now in that region of China that they're creating a lot of the blackouts that the crushing facilities happen to be in, many of them anyway, is about 30% higher than it was a year ago. China's fiscal situation is very tight. I mean, all the world is tight and world governments are tight right now. All the major economies have spent a lot of money since the financial crisis and the Great Recession back in 2008. And then they've piled on even more money since the pandemic. And I think balance sheets are running pretty tight and pretty lean right now in the world's governments. And there's not a lot that the central planners in China can really do as far as making money when energy prices are so high. We're seeing a similar issue in Europe. The natural gas price here in the United States is at a 6 or 7 year high, but it's 4 times the price of what it is in the United States over in Europe. And they're having severe shortages of natural gas in respect to being able to get natural gas through the pipelines. They're having severe shortages in countries like Britain because of problems with the supply chain and not having enough delivery drivers, long haul truck drivers to get the gasoline and the petrol to the pump. So you've got, I think, a couple, three things going on. It's very expensive to produce. Governments are not able to really take in this kind of a hit financially and fiscally. And then you have the supply chain issues that are really hurting us deeply in terms of the world economy. And I think these things are all coming together along with a few other things. And that's why the interest rates in the treasury market in Chicago and in New York is starting to really show a nice big push to the upside.
Well, and it makes me wonder if China is going to get the soybean meal from other countries instead of buying the raw grain. And I also want to ask in the same question about what a more centralized decisions in China would mean for commodities in general. I read a very interesting report that you prepared, and you make the case for that the China is getting back for what they were in the 1970s.
Yeah, I think the likelihood is increasing pretty dramatically right now. And this is a brand new research report I just put out this week. And getting back to your point about the meal, I think you have a very valid point because the meal futures at the Dalian exchange right now is about $200 a ton higher than what it is at the Chicago Mercantile Exchange. And so I think it very well could be that the price point would suggest that between the Gulf of Mexico problems getting beans out of the United States, the price in Brazil being $20 a ton versus the United States Gulf in terms of soybean prices would make the Chinese maybe want to go after more meal and maybe get that from Argentina because they are, after all, the number one exporter in the meal market. And I think that's something we have to watch out for. So if we combine the crushing facilities going down, we combine the hog herd and sow herd being dropped by the central planners last week. We combine the supply chain issues at the Gulf of Mexico because of Hurricane Ida. And then we combine the fact that we have this issue that you're bringing up about my special report I just got done doing about maybe the President Xi moving backwards towards more of a Maoist China, more socialist, a centrally planned economy, a command economy in terms of what the economists would call it. I lay out the case pretty strongly that that's probably where he's headed for a variety of reasons. I think we really do have to be nervous about the soybean prices because the world demand for beans obviously rests with China. And the US demand, in terms of import demand, is clearly 50% of what we grow here, 50% of the world demand in terms of United States shipments out the door is going straight into China. So I think I'm trying to prepare my clients, especially ahead of the grain stocks report later this week. And as we harvest soybeans and you in your area of the world in South America start to ramp up on planting and receive some very beneficial rains, I want to be ahead of this if I can be and have more hedges in place in the soybeans, both in terms of 21 soybeans and also 22 soybeans. 22 soybeans because the price of inputs and the cost of production for corn all around the world in 2022 is going to be sharply higher than what we've been used to the last 4 or 5 years.
And corroborating with that information, after the Argentinian government was beaten down in the midterm election by a center-right coalition, it is expected that the government would flexibilize, making it more flexible regulations on meat exports, and yet could lower the soybean export taxes. I don't think it will be really substantial, but that could happen, and it's a looming decision.
I think this is really important, Luis, and I thank you for bringing that. And I'm sure the clients appreciate that are listening right now because we also have a farmer in South America who has been sitting on a little bit more crop than normal, a little bit more of his own supplies than normal because he's uncertain about his crop and the weather as he gets ready to plant the new crop. And so we could also have a situation develop where the dollar, which is now making a 10-month high, as we go on the air, and the Brazilian currency and the Chinese currency are starting to weaken against the US dollar, we could have a lot of factors come together here that really promote the idea that even if I'm wrong and the beans don't go lower, it's going to be extremely difficult to put together a reason why the beans would rally unless we have a tighter supply on the grain stocks report later this week, or we get yield reports from farmers here in the United States that we've got some problems in the bean fields. Right now, I'm getting some of that, but I'm not getting nearly enough to make me come off of my 49 and a half bushel yield. I think we're right around 50 bushels. I think maybe a little bit less than 50 bushels as I get more and more information from clients. And as the USDA comes in with about 16% harvested here in this country, which is 2% behind last year at this time. And I found that very interesting on Monday's crop progress report that the beans are 2% behind last year in terms of harvest, while the corn is running about 4% higher than last year. This could indicate that those corn yields are down because we're running through that corn so quickly. It's very dry, the test weights, the standability, stalk quality issues, these all could be factoring in to maybe the USDA being more incorrect and too high on corn yields than they are on soybean yields. So this is kind of the dynamic I'm looking at as we go into the fourth quarter, with the grain stocks report being extremely important to the spreads and keeping that front end market premium to the back end. That's the key with the soybeans, if you ask me, is we've lost the inversion and we've gone back to a carrying charge in the corn. We've gone back to a carrying charge in the wheat, but the soybeans have kept that premium in the front end. We don't want to lose that.
Yes, and I wanted to ask you about the Federal Reserve announcement from last week. They said they are anticipating what they call tapering, and they will take money out of the economy as early as in November, according to what Powell said. So, what do you think that would impact the commodity prices?
Yeah, again, a chart that we've made for the viewer today shows the consumer price index here in the United States against the 10-year Treasury yield, not the bond price, but the actual real yield or the real interest rate on 10-year notes. And what you notice is that higher consumer price index has attracted the Federal Reserve to begin thinking about tapering. They want to go ahead and start if the unemployment and jobs numbers can come in consistently better than what they've seen over the last few months. And they're on track, as they said this past week, they're on track for doing that when they come back in November again and meet. Having said that, Luis, what this chart on the 10-year yield shows me, though, is that we are going towards the Treasury yield high of about, I think, 1.7%, 1.75% from back in March. If we would get up to that level here in the next 30 days, I don't think the Federal Reserve, I should say, will feel as though they need to really do any tapering at all, because the real interest rate and the real world market interest rate, I should say, is going up, and it's essentially doing the job of the Federal Reserve by cutting back on the money supply. And so it's putting, it's drawing down the equities markets right now, and it's really creating a situation where the overall market is thinking about putting more money and parking it in the cash. And I think that's ultimately what the Federal Reserve wants at this point. So as we see China change their economic model, if I'm right about that, we see these power curbs, we see these supply chain issues, and now we see the yield start to go higher. And that 10-year note, if it would go back up to that 1.7+% level, I think the Fed would feel like they don't need to taper as aggressively. That may come back and help the commodities eventually, but it could be pretty rough waters in the fourth quarter of 2021 if we continue to see money leave both commodities and equities because the interest rate is going up in terms of the bond markets.
And as we see the Brent crude oil reaching $80 a barrel, what do you think will happen in terms of pressure to inflation and to commodities in general?
Yeah, and I think this has been happening this week already. As far as to give you an answer, I think this has been a supportive feature to the market as long as the dollar doesn't rally. I think this is the key. As long as the New York crude oil market can go higher with the London Brent and the dollar doesn't rally, then the commodity index funds, I believe, will come in and buy into this market. That's the last chart I'm kind of showing you and giving to the viewers today. And please sign up for a trial on the research that I do at globalcomresearch.com so I can explain this in more detail. But this is last chart is a Standard & Poor's agriculture commodity index, and it's a monthly chart. Notice the two purple lines that are coming together and forming a wedge, forming a point coming into the end of October. Very important, because that's right in that fourth quarter time period. That's right in that time period that we are heading into that last quarter of the year. And so I think it's really important that the S&P Agriculture Index chart that we're looking at, which started out by making a new 3-month high in this past week, was able to do that. For the month of September, it was able to take out the previous 2 months highs. It's now starting to give way. Well, what allowed it to take those highs out? Well, it was the crude oil market being able to lead and pull up the other commodities like agriculture and the grains, because the dollar was still in a channel and had not broken out to this new 10-month high. So I think this is very good news if the crude oil continues to go up in the short term, because it'll attract investment. But remember what I said about the bond yields just a minute ago. If we see the dollar go up because bond yields are going up, then the money will get parked into cash. And the market will especially get nervous about the commodity emerging markets, which they associate with commodities. So if the dollar goes higher, the buyers leave the commodities because they get worried about the emerging markets, and they associate commodities and emerging markets, especially China, as one and the same, essentially. So it's a very tricky dynamic we're in right now, and that's why the debt ceiling issue in Congress could cause a real whipsaw in this market. I actually think, Luis, if we did not get the debt ceiling agreed to, I think the dollar may actually fall sharply, and that may actually spur even more inflationary pressure and create even more commodity buying in the short term. So we really got to stay on top of this next 2 weeks.
And what's your outlook for wheat? Because wheat is not, it has not the same relationship with the energy sector, so it's a different story there.
Yeah, it is. It's a different relationship with the energy sector, but it's still very closely tied to the dollar, and it's been increasing. The relationship between soft red wheat and Chicago and the U.S. dollar has actually been getting more negative over the last 3 weeks, and so I think it's going to be probably one of the leaders to the trend in this market if the dollar keeps going higher. I think that hurts the wheat even more. So that's one of the things that I think we really have to watch out for, because the wheat is the leader. We do get fresh small grains numbers this week by USDA that will give us fresh supply demand fundamentals here in the United States. So I'm hoping the dollar kind of calms down. We get a good USDA report, and the wheat can continue to take us higher, because we did get a new 5-week high in place in the soft red wheat earlier this week, thanks in part to that crude oil and that dollar weakness.
Yes, and what will be your analysis about the meat sector?
Yeah, this is going to be a lot more difficult, because I think we're seeing the cattle market react to the stock market. There's a very strong positive price relationship between the stock market and the cattle futures. We had a very bullish hogs and pigs report that the market has been essentially disregarding any other fundamental factors since that hogs and pigs report came in so low on supply, and not just low on marketings, not just low on kept for breeding, but farrowing intentions were below the lowest trade guesses by the Newswire estimates. So the hogs have been rallying, and that's been trying to support the cattle. But I think once the hogs get done rallying, if the stock market continues to go lower, then I think the fat cattle probably have more downward price action to them. I don't think the downside's much more than $4 or $5, though, Luis. I think the more likely scenario is that the fat cattle and the feeder cattle kind of go sideways, and the hogs hold on to their premiums. So that's kind of the dynamic I see right now, because I do think that the hog complex and the pork and the beef complex both have the likelihood of seeing continued strong import demand of beef and pork, unless that dollar gets out of whack and goes sharply higher. And then about a month from now, we'll probably start to see lower numbers in our exports.
Well, thank you for bringing the big picture again, Mike.
Thank you, Luis, for all your comments too. Appreciate it.